Thanks, Georgie, and thanks for inviting me on today's session. Actually, I was just picking up something that Steve said that I think probably sums up my entire presentation, which is, although it's entitled Funding Options, in reality, all this is about uncertainty. It's about trading that uncertainty with external parties, so that the claimant doesn't have to face perhaps some or maybe all of the uncertainties that flow from the costs, how much it's going to cost to bring a case. I mean, everyone can budget as much as they can, but there's always uncertainty over the level of cost. There's the claim value itself and what that's worth. There's actually probably the most important uncertainty, which is whether the case is going to be successful or not. But even if it is successful, there's uncertainty over whether the award that's received or settlement can be actually enforced at any stage. So there's a lot of uncertainty in litigation, and it's about to be, as Steve says, a lot more litigation. So fortunately, there's been a growing market of funders and insurers for the last 20 years it's a niche industry still, even though it's got gathered a lot more press, particularly in the funding sphere. But there is a significant amount of capacity now available for meritorious cases, and that is the key. The question is whether the case can be supported for funding, and that usually comes down to both the prospects of the case succeeding in the views of the legal representatives in this country, perhaps the barrister, but also whether their case is economically viable for a third party to get involved, and that's probably the more difficult question for many cases. So if I just quickly, sorry, next slide, please, if you didn't mind putting on. Yeah, about the judge, just very quickly, I thought it'd be helpful to understand, for you to get some context as to who I am. So this is a company that I've been working with for 15 years or plus. We operate in the UK, obviously. That's where the market has developed, particularly the after event insurance market, although funding is perhaps seen as perhaps an Australian or a US product in the main. In fact, the majority of litigation funders are either domiciled or operating in the UK. So it's a big hub for litigation funding, and we had the first ever association of litigation funders based in England and Wales, which we were a founding broker member of at the time. Yes, so we actually have a slightly different role in relation to fundings as of this year. So we used to be a litigation insurance broker and litigation funding broker, and we still are a litigation insurance broker, but we now have a separate funding vehicle, separate funding arm, so that we can offer funding solutions directly. There are many different reasons for that, but we wanted a streamlined approach to be able to provide liquidity alongside insurance solutions. So I'll explain that in a bit more detail in a moment, but perhaps it'd probably be, if we remember, next slide, please, if you wouldn't mind, that we can then look at the products. So the products I'm going to be talking about are the insurance products that are available. That typically in this country is understood to be after the event insurance, or ATE insurance, to cover the own side's fees or the disbursements that a claimant might need to incur, but probably best known though for the fact it covers adverse costs, your opponent's costs, in the event that the case is unsuccessful. In fact, I like to call ATE adverse cost insurance, so there is a differential between insuring your own side's costs and your opponent's costs. We'll talk a bit more about sort of typical pricing for that sort of policy and what it covers and what it doesn't cover, but it's often used or seen in commercial litigation in respect of a security for cost application, because very often an after event insurance policy will be put up as adequate. They try to make it adequate security for cost in the eyes of both the opponent or the court, and generally speaking that's accepted, and I can explain how. Also talk about third party funding. I've put next to that cash flow. That's because the difference between an insurance product and a funding product is that although both involve taking the risk away from a claimant who might hold a claim, it's the funding that provides the actual cash flow. An insurance policy will only pay for a claim at the end of the case once the outcome is known, so that will reimburse a claimant who was insured for any costs that they've expended throughout the life of the case, but they still have to find those costs. They still have to pay those costs when as and when they become payable during the life of litigation. So insurance is very much a risk mitigation or a risk transfer product, and funding is both a risk transfer product because it will put the risk onto a funder, but also the funder will provide the cash flow. And what we'll see in a minute is that some organisations actually really need insurance rather than funding. And lastly, there is another section of services or products in relation to monetising claim holders' awards or judgments, and that can include both monetisation of an award and enforcement costs if there is going to be a sort of secondary process of enforcing that award. There's also a form of insurance called appeal risk insurance, or as it was described to me yesterday, as judgment preservation, which is where you can insure a portion of your award from being overturned by a subsequent appeal. Next slide, please. Next slide, please. I think you might be stuck on the slide there. But the what the next slide should show, if you can see it, and now I can see it. So this is a typical example of an after-event insurance policy in terms of how it's priced. So after-event insurance is different from other forms of insurance because typically, and this is not always the case, but typically the premium is only payable in the event of a successful outcome in the case. And particularly what I mean by that is a successful outcome which generates a recovery for the insured party. So physical payment, so it includes enforcement. And the premium that the insurer receives for having provided insurance throughout the life of the case is collected from the recovery. So, but because if there is no recovery, then there is no premium. So that's why it's called a contingent premium. What you tend to find is that these days, particularly for larger commercial cases, when I say larger, I mean cases where the limits of indemnity are above £1 million or more, you tend to see a bit of premium payable up front to the insurer, which is non-refundable regardless of the outcomes. If you lose, you've still paid that element of premium. So that's a sort of the upfront part. Then there's also an additional contingent premium, which is payable only from the recovery at the end. And that contingent piece tends to be staged to keep the premium proportionate to the exposure that the insurer would face. And so, for example, it might be a much cheaper contingent premium if the case settles early at an early stage in the proceedings, or maybe pre-proceedings. But it goes away to trial, then it will be the maximum contingent premium because it's gone all the way to trial, and the insurer would end up paying a full limit of indemnity if the case was lost. So the example you can see in front of you here is just exactly that. There's no reference to any upfront premium. This is an example of a case where it's purely a contingent premium, which is not uncommon, particularly for cases where the limits of indemnity are less than £1 million. But here we're seeing a premium against £1 million limit of indemnity of between 100,000 to 200,000 in the event the case settles before the service of defence. So that's stage one. Stage two goes up to 250 to 450. That's just the range I'm giving you, as typically the sort of range we see, up to 60 days before trial. So if the case was successful, perhaps at a mediation, or there was a roundtable meeting or something that happened before the brief fees were being incurred for trial, then the premium is lower. But of course, once you get into that latter stage and you're running up to trial, then both sides are arming themselves for full hearing. The costs are going to rack up, and the insurance premium goes up accordingly. And typically, you might see a premium between 50 to 65% of the level of cover. So that's 500 to 650,000 pounds against a limit of £1 million. So this insurance isn't cheap by any chance, by any stretch, but it is what makes it a very appealing product to litigants. Is that the premium is only payable from their recovery. And that's what makes it an affordable exercise. So next slide, please. Actually, but before I move on to this, I should just mention that there's one other cost that I didn't mention in the last slide, and that's in relation to security for costs. If you put up an insurance policy as a mechanism to get through a potential application or an actual order for security made by the court, to give the other side, to give the opponents confidence that you'll pay their costs in the event the case is lost, or give the court confidence that you'll pay those costs, then the AT policy on its own would probably not be satisfactory security for costs. That's because of a Court of Appeal case called Premier Motors, which decided that in most circumstances, a policy has too many get-outs for an insurer to not pay a claim to give real certainty that sufficient to meet the security for costs order. That's not to say these policies are widely avoided or cancelled. I can tell you from 20 years of experience that is certainly not the case. Cancellations and non-payments are extremely rare, and they normally occur where the client has fabricated some sort of evidence or been fraudulent in some way on the insurer as much as the court. But the fact that it theoretically is possible was enough to prevent these policies being adequate security. So the way around that is the insurers will issue what's called a anti-avoidance endorsement, or possibly another mechanism called a deed of indemnity. But in both instances, it's a augmentation to the AT policy that will give the courts comfort that the policy will pay, the insurer will pay the opponent in the event of an adverse cost order, even if there's been some kind of breach of the policy between the insurer and the insured, and that allows the case to continue using the AT policy as adequate security. There is an additional cost to that, having that augmentation, and it tends to cost about 10% of the level of the security required. So you might have a policy for $1 million and a security order for 500,000. The insurer might issue an anti-avoidance endorsement for 500,000 to match the level of the order, and the premium might be £50,000 because it's 10% of that 500,000. So it's additional cost to factor in if there is a need for security for costs. So moving on to third-party funding. So our funder launched in February to March 2021, so just recently, is Urso Capital. There are many funders in the market. There's probably well over 30 worldwide, maybe more. There's well over £1 billion of capital, if not more, available for litigation financing worldwide. We are interested in funding, or in most of its forms. We only fund commercial litigation, and we're probably mainly driven towards single case funding, so as I call it, facultative funding, where we're looking at an individual matter and looking to support it in creative ways. But we'll also fund law firms to provide risk-bearing retainers and so on, much like we heard earlier on from Hannah about the sorts of arrangements that can be arranged with law firms. And we also look at monetization of awards, which I'll be talking about in a minute. The difference, perhaps, or a difference between us and some other funders, is that some funders will focus purely on the really big stuff. The case is worth millions and millions of pounds, £10 million plus, whereas we're probably more interested in cases that have a lower limit of indemnity, lower level of value, and require a less funding commitment. So we tend to be looking at sort of more modest claims, but typically you still need a ratio between the level of costs to be incurred and the damages and the value of the claim to be something like 1 to 6 as a minimum. The ideal in the funding terms is 1 to 10. So for every pound of costs, you get £10 in award value, and that ratio is quite hard for most cases to achieve, particularly in the modest value case range. So we could do something at 1 to 4, but in reality 1 to 5, 1 to 6 is probably about as low as you can go, even with the most creative minds and how these things can work in the funding world. Next slide, please. So just to give an example of pricing with Urso, although the same would probably apply to other funders, everyone's got different price points. Obviously, it's a competitive market. We would tend to see a case where we would describe it as lower risk, as attracting a level of return as described in this table somewhere between. So the way it works in the funding world is, I should explain, is you have a firstly, if a funder's funded your case and deployed, say, £100,000 of funding, they would expect to get that £100,000 back and then attract a success fee on top. And that success fee is generally calculated by reference to a multiple of the amount of the money deployed. So if £100,000 has been deployed, this table says that if the case if that money is returned within 12 months because the case has been successful in the first 12 months, then there'll be a 0.7x return, which means a £70,000 return. So then it goes up to 1.2x and then 2x. So if it settled in or was won at trial after 36 months, then £100,000 funded would be returned to the funder, and then an additional 200,000, i.e. 2x, would have been paid to the funder. So it's best described in multiple terms because these aren't typically interest rates. They are much more akin to a private equity investment, which is why language like multiples is used. And as you can see, if the case is characterized as a higher risk, then the multiple goes up. And that's how most funders will describe their pricing, as a multiplier of the level of their deployment. But that is not the only way a funding transaction can be structured by any stretch. Originally, back in the early days of the market, say 10, 12 years ago, most of the funding arrangements were just simply a percentage of damages. I shouldn't say it simply, because it wasn't quite like that. It was a percentage of damages or a multiple, whichever was the greater. So that wasn't particularly popular with many clients because it meant that the funder was effectively having their cake and eat it. They had the best outcome if it was a low value award, because they would get the multiple return ahead of the client, ahead of the claimant. And if it was a percentage of damages and a high value outcome, they would do very nicely because it'd be more than the multiple. Typically these days you see one or the other. It's either a multiple return or a percentage of the damages, but the multiplier is more popular. You will always have, with every funding arrangement, a waterfall arrangement or a priorities agreement, as it's typically called, and that will set out which of the stakeholders will get paid first from any recovery. And normally at the very top of the waterfall, the funder will get their deployment back first, so the money they spent on the case for you, they get that back first, and then there will usually be a split between any insurance company that's due any premium, the funder that might be due any fees, the lawyer that might be due some sort of success fee because of a CFA they may have had in place, and then generally speaking, the claimant is at the bottom of the waterfall and gets the residual, although that can obviously be negotiated, and it's very much down to the quality of the case as to what can be negotiated. So next slide, please. So the next slide is about monetization. So I said before that there are circumstances where if you have an award, for example, then you might be holding on to something that on the paper is worth, say, £10 million, but if and until that award can be enforced, is really quite worthless, depending on who the defendant is, and even if they have money, whether they're willing to actually give it up easily. So there is a growing market, a fast-growing market, and I wouldn't describe it as litigation funding, because it's not really, because it's more about advancing the value of a legal claim. Once judgment has been obtained, and what you'll typically see is somewhere between 5 to 25% of the value of that award being advanced to the claim holder. These tend to be quite big numbers. You don't see this happening very often on small cases, with the one exception, which is insolvency cases in the UK. There is a market, a sub-market of funders who will provide monetization for insolvency practitioners, and they would normally they have a slightly different approach. They may take over the entirety of the claim and pay so many pence in the pound for the value of that claim, and then take over control of the case. Whereas a lot of other situations internationally, particularly international arbitration awards, where there is quite a significant enforcement process after even getting through what could be years of legal wrangling to get the award in the first place, they would probably more likely share the upside with the share the eventual recovery with the claim holder, on top of having paid some element of the award up front. But perhaps more importantly, the monetizer will take the position of funding the ongoing legal cost and enforcement budget to actually see that award realised in the future. Obviously, a lot of corporates will be concerned about control and ownership of the claims, not just in relation to monetisation, but with litigation funding generally. But you'll see more instances of funders or monetisers taking control in where they are post judgment and where they are seeking to, advance claim value. In some situations, for example, they might buy shares in the claim holder, or take an assignment of the claim. There's all different ways that can happen. Or it might just simply be the case that the claim holder will continue to fund everything themselves and take the case forward and have control, but they have had some value released, and they agree to pay that back plus a significant share of the eventual ultimate recovery. Next slide, please. Perhaps the future we'll see more situations where monetisation occurs on a multi-case basis. Of course, this isn't going to be relevant for parties involved in significant amounts of litigation worldwide. So this is probably going to be international energy companies and so on who have multiple cross-border disputes. In those situations, I could well see there being quite a competitive advancement of funds, perhaps on an interest rate basis, where there are multiple chances for the monetizer to get their money back. It may be that they monetize a case that ultimately doesn't realize any funds, but case number 2 and 3 do, and that returns the level of the funding commitment they've put out, as well as the return at the end. If this the sort of structure I've seen, I haven't seen it dozens of times. I've seen it probably 2 or 3 times for a lot of large corporates, but they have typically been very big numbers. 20 to 200 million is what I've seen in the past, and ultimately there could be a scenario where a corporate who has significant amounts of litigation can negotiate very competitive portfolio arrangement for themselves, which might include, for example, financing some cases that normally funders would never touch. A good example would be if you included a defence case, and typically funders won't fund defence cases because there's no money at the end of the whole process. That's why this is very much a claimant-orientated market. But if there is a multiple number of cases and a good chance that the claimant cases will generate a return, the funder might be willing to have a funder defence case as a loss leader to some degree. Next slide, please. So just a slight recap, and also a comparison. And this is a slide that's really designed to provide what I see as the key benefits for GCs of the 3 product areas that I've discussed. I'll just, at this point, it might be worth just giving a quick anecdote about a major airline that we worked with once, and they came to us as a broker of funding. So this is before we had Ursa Capital, and they said, look, we just want to get a competitive tender going for litigation funding. And they had quite a big requirement. It was, multi-million-dollar requirement for a tens of millions dollar case. It was an international arbitration against the state, actually, and they were looking for a funder to fund all the costs, or at least share the costs with them. And this was an airline that did not need money. They had tons of cash. But I think what they were looking for was a way of getting buy-in internally to bringing this case, because there was a sort of sense of litigation fatigue in other areas of the business where they'd been involved in long-standing litigation, probably with the same state actually. And there was a sense that if someone else was going to take all the cost risk on and the uncertainty on, then they could bring this case forward and keep some of the value at the end. So it wasn't a bad strategy. But when we looked at it, we did then advise them about litigation insurance. And we told them about, the fact that, if you have the cash, you can fund this case, knowing that the insurance policy will pay a claim at the end to reimburse you for that outlay. And then the benefit of that is significantly cheaper than funding. As you may remember from the examples a minute ago, if you think about the cost of the insurance in that example against the cost of funding, it's typically a quarter to half or third of the cost. Insurance is significantly cheaper in that respect. So when we explained that to them, they went through a massive process, having tendered out to all these funders and got all these different offers, because it was a very strong case. And in the end, despite all these offers that became increasingly competitive, they ended up going with insurance because they had the cash and they didn't need liquidity. And so ultimately they kept a much greater share of their upside because they only engaged with insurance. And that's a message I always tell GCs of major corporates, because the litigation insurance angle, particularly for own costs, is not very well understood in the marketplace. And it can be a significant cost saving if money isn't the issue, but it is about uncertainty and risk transfer. So that's what this table really highlights here. Insurer does not fund legal costs, but it is a risk mitigation tool. And it assists with the internal sign-off for legal spend, as I just explained in that example. And it can be considerably more cost-effective than when offering up security for costs than putting cash into court, particularly if that cash is going to be utilised for the business and make the opportunity cost is what I'm referring to in relation to putting cash up for security instead of a third-party insurance policy. Litigation finance, on the other hand, is a necessary product where it isn't just about risk transfer and it is about cash flow, and particularly where the company wants cash flow in a way which isn't going to create a balance sheet issue, because it's it's not a debt, it's a non-recourse investment in the case, which is only payable from the recovery that is made by the claimant. So there's no interest to service, and it doesn't normally impact the balance sheet. And it also gives confidence. I mean, all these products give confidence, really, that the case is a good case because a third party has risk assessed the case and believes in it. So that's another important factor. And then claims monetisation. Obviously is very popular with many people because we get a lot of inquiries about it, way more inquiries than we have good quality monetization opportunities. But it generates immediate revenue for a corporate who has a claim, and it takes away a massive portion of uncertainty about whether or not you're ever going to see any money, because obviously that money, once paid, is non-recourse. You haven't got to pay it back. It's yours, regardless of all the uncertainties I mentioned right at the top of this presentation. And of course, it monetizes an off-balance sheet asset. So it's suddenly cash imported into the company, which may not have been recognised as a contingent asset in the first place. I know some companies do that, and they will do, but many people will suddenly see a realisation from litigation early before the outcome as off-balance sheet assets. And of course, all of these things can be made more creative solutions, and you can come up with more interesting structures where there are more than one case, which is what the point at the bottom is saying. That once you introduce the idea of cross collateralization to across multiple litigations or arbitrations, you can create some very interesting and competitive structures. So I think that's it. If this next slide is really about questions, isn't it? Yeah.